Neil, what is the foreseeable future? Seems to mean something different now than it did maybe a little while ago.
I think the foreseeable future means between now and the end of the year.
Okay, well, that's pretty specific.
But there's disagreement about what happens between now and the end of the year. Do they start
and what highly
to taper?
accommodative means,
Do they start to taper, or do they taper at all?
They start, well, tapering by definition means paring back a bit. Now, saying a monetary policy is going to be highly accommodative, you could be buying $65 billion in assets and still be highly accommodative. You can keep the Fed funds rate at 0 and still be highly accommodative. In fact, that's what the Fed has referred to their policy since the funds rate has been at 0. So, no, I mean, I think that the Fed is likely to taper in September. If you look at the minutes, what you found was you had, quote, many members looking for a tapering of policy contingent on improvement in the labor market data. You had several members that were willing to taper fairly quickly. You put those two together, many plus several, I mean, that adds up to a majority. And so remember that all of this was also right before the latest employment report, which was better than expected and showed upward revisions to prior months. So, you know, my sense is that we're getting closer to the tapering of the Fed's asset buying program, and I wouldn't be surprised to see a $20 billion cut to it at the September meeting.
Neil, I want to throw at you a quote from friend of ours, and perhaps even yours as well, David Zervos, this morning writing, QE is working very well. Ben has been able to throw out the dirty hater bathwater while leaving a happy and clean risk asset baby in the tub. Would you agree?
I think that QE, I think the Fed in general gets a lot more credit and takes a lot more blames for the moves in the capital markets than it deserves. If you look at the corporate profitability of companies traded on the S&P 500, it's been generally improving. So my sense is that, generally speaking, the improvement in risk appetite has been supported by stronger fundamentals, because the equity market's ultimately the price you pay for future corporate profits. This idea that the Fed is just going to goose the equity market higher forever, I think, is just, you know, quite frankly, ridiculous, because if the balance sheet of the Fed is all that mattered, the stock market could never, ever decline.
We're also watching the bond market very closely for any gyrations there, and that has also the potential to sort of spike when you look at rates. Even Fed members coming out after Ben Bernanke's press conference had to come out, walk back a little because of the wild market reaction. This has to be a risk.
Well, the question is whether it continues. You saw that after Bernanke spoke yesterday, you did see a slight rally in the Treasury market. But then let's look at the fundamentals for Treasuries as well. Inflation is low. The deficit is narrowing. That's going to help anchor longer-dated Treasury yields, in my view. And as I think, as time goes on, the Fed and the markets will begin to figure each other out. And the Fed is still going to keep their foot on the short end of the bond curve, which is ultimately what they control. So that's going to create plenty of near-term trading opportunities in the short end.
Well, to that point, there are several people, including Zervos for that matter, who think that one of the things that the Fed was intending to do, whether it was to goose equity prices or not, most definitely to get some of the leverage out of the long end of the curve in the bond market. Would you agree?
To a certain degree, yes.
Do you think we should read into anything that he's not going to Jackson Hole in a few weeks?
No, I think he's probably working on his memoirs.
So you think it's definitely that he's not going to come back for a third term?
I think there's a very high probability that he won't.
Do you think that's disruptive to the markets?
Do I think it's disruptive to the markets? No, I mean, Ben Bernanke is not the smartest man in the world. And, you know, let's, you know, to me, it's kind of amusing. I mean, let's have a little bit of confidence in the...
Wait. Ben Bernanke's not the smartest man in the world?
No, he's not.
What do you make of the talk, then, that somebody who might consider himself the smartest man in the world might end up running the Fed, namely Larry Summers?
It's not going to happen.
What, you think Janet Yellen?
I think it's Janet. I mean, Larry Summers, I don't think that the president will nominate him. I think it'll probably...
Too difficult a confirmation process?
Not only that, he hasn't had that much experience within the halls of the Fed. I think nominating an insider at the Fed, someone like Janet Yellen, maybe even a Don Cohen or an Alan Blinder, I think would be far more favorable to the staff. But, I mean, the point I was going back to, Ultimately, the economy in the United States is bad. You know, it's right after the 4th of July, but I'll say it anyway. It's backed by hundreds of millions of workers, companies, innovation, the country that sets the productivity frontier for the rest of the world. It is not backed by this.
Are you running for office?
No, I'm not. What I'm saying is this idea that it's just Fed, logically doesn't compute.
Neil, before you go, I have something to show you. This is the cover of the new Business Week. Can we bring it up, please? First word that comes to your mind.
Totally accurate.
Accurate. The hedge fund myth, the underperformance. I mean, there is this idea, perception versus reality. I know you work with hedge funds in your job. They have to be clients of yours. What kind of environment is this for hedge funds?
Well, to a certain extent, you know, one of the arguments you hear a lot is that we may see an ongoing rally in the equity market because a lot of these hedge funds have been underperforming. They haven't been fully invested in this equity market rally, and it's getting increasingly.
And they need to put up some numbers.
Exactly, and it's getting increasingly costly for them not to be invested. So I think that, along with the ongoing improvement in the underlying growth fundamentals in the U.S., should push the stock market higher into next year.